Rob's Child here with another edition of discussing the book Security Analysis by Benjamin Graham and David Dodd. Today we're going to be looking at Part 1, Chapter 2, Fundamental Elements in the Problems of Analysis, Quantitative and Qualitative Factors. I'm going to start with a quote from the very end of the chapter. This is a quote. In the mathematical phrase, a satisfactory statistical exhibit is a necessary, though by no means a sufficient condition for a favorable decision by the analyst. Now, this chapter talks about just as the title suggests, dealing with the quantitative versus qualitative factors. And he basically kind of indicates throughout the chapter mostly that quantitative factors are more important than qualitative, and it's important to know what qualitative factors are versus quantitative. And some figures that seem like they might be quantitative are actually qualitative. But even if your quantitative figures are perfect and all, the math looks perfect, it's not enough for the analyst to fully determine whether or not you should buy, hold, or sell the security being studied or observed. I'm going to try to make my videos better. The last one was a little too long, a little too disorganized. I might redo that one actually, but I digress. So once again, disclaimers. This is in no way to replace the information of this book. This should act as a supplement, a place to maybe discuss your own reading of it in the comments below and maybe get some ideas that can help you understand this chapter from myself. If I happen to uncover anything that needs uncovering. All right, so the chapter starts with going through the four elements of a security. He talks about the security of it, the time, how long you're going to have it for, when you buy it, when you sell it, the price, and the person. He discusses first in this chapter, he calls it the personal element, and how deciding what to do with the security depends on the person. It depends on their training, their competence, their temperament, and their preferences. So these are not determining factors in analysis, but these are factors that are going to affect whether someone will be buying, selling, or holding a certain security. For some people, certain securities are very inappropriate. And, when people talk about that, they're usually referring to older retired people that have limited income, limited investments, should not be taking risks that they can't afford, basically. You need to have more secure income, basket of preferred shares and bonds, towards the later part of your life. Of course, that assumes that, you're kind of living on just what you need. A lot of older people today, a lot of the baby boomer generation has so much wealth that they can actually take a lot of risk and still have plenty of income. So the idea is if you have limited income, that should be a consideration, especially with the personal aspect of choosing securities. These are all pretty basic, obvious things. Next pointer I wanted to mention was how he said, how I should stop saying he, it's they, it's their book, right? Benjamin Graham and David Dodd. I think it's mostly Benjamin Graham, but I could be wrong. They say we, in referring to both of them as the authors throughout the book. But anyways, I digress. What they say is analysis is good for ordinary conditions. And as I've said, I've mentioned in the previous chapter and introduction, he talks about this. So he mentions this a lot. When things are not normal, like right now, we have really high inflation. The Fed doesn't know if they should be increasing rates or staying at the same. They're not really sure. They're hoping that pausing right now. It's June. They just did the first pause ever since they started raising rates. Something like 7-8 months ago. I don't know. They've been raising at a very, very fast pace. Now they're pausing. But inflation is still high. The yield curve is crazily inverted. But unemployment's still low. But these are not considered normal times. These are not ordinary. This is not what I would describe as a situation where we have ordinary conditions. And so, for right now, analysis does have even more limits than it normally would under a more fertile environment. Next point that I liked in the chapter was when they mention that people lose money buying too much security, so too much premium for security. So this is in reference to people basically not taking enough risk. Think of the difference between the yield you can get on a AAA corporate bond being a lower yield than that of a AA bond or a A bond or a B bond. What they say in this is there's too many people that pay too much for that security because you're not paying for anything. You're not really getting anything more. Over time, it's been pretty much proven that more risk pretty much always pays off. If the company can pay their debts, and companies all the way down to maybe a B level, or even some people say that's not enough risk. They only want C level bonds if they're going to be going into corporate bonds. So I don't know where that line is, but it's a good point. People losing money by purchasing too much security. Now, of course, institutional, and for the person, or the institution that's buying the security. So AAA corporate bonds might be better for something like a bank to own than an individual trying to, increase their returns. All right. So yeah, too much premium for too much security, and that's just something you want to avoid. Let's move on. He relates this example to buying merchandise, and I love this because I think about this myself. When you buy a cell phone, for example, and if you love iPhones, great, but you're paying $1,000 for something that can achieve, in my opinion, the same things that my Xiaomi Chinese phone can accomplish for 1/5 of the cost or less, and it even the specs are comparable. You can So do I want to pay $1,000 or do I want to pay $200 for the thing that functions the same? His examples, he brings up the quality of paint and watches in particular. He doesn't, apparently these guys don't like expensive watches or expensive paints because the extra premium doesn't give you an advantage that's worth the premium because it gets the job done. And so their perspective for analyzing securities includes that idea. Too much unneeded quality. You don't need AAA bonds over AA bonds. Why pay for a slightly lower yield when the yield is well secured at a slightly lower credit level. A small example, but you can take that into stocks too. You can think about preferred stocks. Why pay more for a supposedly slightly more secure preferred stock over? Well, you get the point. So yeah, I can apply mostly to bonds and preferred stocks in that case, or even value stocks that pay like the same dividend for the past 50 years. It goes up well, anyway, you get the idea. All right, so popularity. Okay, so next point he goes on to say is about popularity. So what I wrote here was popularity matters, but good analysis or good analysts will be able to disagree with what's popular. So certain stocks are extremely popular. Tesla is extremely popular. Should you ignore that? You should not ignore that. That's a good reason to not short something. That's a good reason to not sell something if you happen to already have it and it's overvalued. Maybe you want to hold it instead of sell it. But so popularity does matter, but a good analyst can and should be considering the arguments against whatever's popular, if it's popular to short something or if it's popular to buy something. Right in this particular time, the mega cap stocks seem to be overvalued compared to the mid cap, smaller cap companies relative to their financials. So that argument's perfect for what's going on right now in markets. All right, and then he says higher risk needs more digging. So another thing he talks about in this chapter that I remember is that it's not necessary to dig too deeply into securities. I'm always thinking like, okay, well, if I knew every single detail of this company, maybe it would help me make a better decision. A lot of the details that are put out there in reports are it's not useful information. It doesn't actually help you. And sometimes more information can actually make things more confusing when regarding securities. So his point is, try to cut out the nonsense and pay attention to what really matters, which are certain qualitative factors and quantitative factors, or quality and numbers, the numbers involved and the quality, and the things like popularity, things like speculation of the industry, the company, how the management's doing, those being the more qualitative factors. So he also mentions briefly about character of management. I'm hoping the book goes into being able to discuss the quality management more so. But he does mention there severe limitations of judging character of management, being especially because opinions and bias are involved. And again, these are qualitative factors. So we're going to go on to a few other points mentioned, dealing with avoid overproduced industries, look for underproduced industries. So just like everything kind of is cyclical, and how many times do we have to see the same pattern? Oil goes way up, all of a sudden everyone's like, oh, well, now it's worth it for me to invest in getting oil. And you get tons of companies doing the same thing. All of a sudden you have a huge influx of oil coming into the market, and guess what happens to the price? It goes down. Guess what happens to the value of all these companies, including the big boys that were doing it before the prices went up? The value of the companies goes down, the value of oil goes down. You end up in this cyclical pattern that happens across all industries. Microchips right now, we've been in a kind of a major squeeze, and so you're seeing Intel, I think Microsoft, you're seeing other companies getting into the microchip industry, which is going to devalue microchips because more people are going to be producing them. And so that's something to take careful note of. It's easy to think, oh well, microchips are making so much money and they're worth so much now, they're just going to go up forever. No, they're not, because you know you have, like I said, you have more companies that are going to be seeing that it's more profitable. Immediately, you're going to have more companies producing more. Eventually, the supply outweighs the demand, and that's the world keeps turning. So, all right. So he says, one nice tip: look for long depressed industries. One of my favorite ones is the uranium industry, since I think for the past decade, uranium has been very cheap. Dry bulk shipping has been very cheap. These are some areas that I'm particularly interested in right now, that because they've been so cheap for so long, they've been invested in less and less and less. And they haven't been building ships. They haven't been producing more uranium. If you can find areas that are in that part of the cycle that have been ignored for decades, coal is another one that I like to take a look at every once in a while. The whole green energy thing is great, but at the end of the day, people need their lights on, and that's being suppressed by governments, and no one wants to invest in coal. And funny enough, that may end up being the most profitable sector over the next 10 years as far as I know. I mean, just the kind of a example. I haven't looked at coal for probably a year now, but it was an interesting area I was looking into a while ago. Same with oil, like we're going all electric. You know, people are more hesitant to invest in oil because of the whole green movement and all of that going on, and the electrification of vehicles. I think Lynn Eldon's right in typically when we get new sources of energy, we just add them to our old sources of energy. We don't really ever replace old sources of energy. It's more additive than it is ever replacing old forms. We still burn coal for electricity all over the world. All right. That's probably the best example of that. All right. Okay. Oh, another really great point that he goes into is overvaluation. He says is very common because good management is counted twice. So, according to this book, these guys look at the valuation of stocks and they say that, okay, this company has great management. Everybody knows it. Everybody believes it. But is it so good that, it gives that much of a premium to the value of this company? And he says, be careful with that. In their experience, good management is counted twice. So when something's getting overvalued, it's just another concept to kind of have in your head when you're analyzing the value of a company and their securities. All right, and then we go into future higher earnings. Is always only assumption, and this is something, as someone that has started this only about 4 years ago. It's been about almost 4 years for me studying securities and markets. I see those charts on Yahoo, right? You have the revenue growth going bigger every year, and the earnings, sometimes the earnings are reversed. They get deeper into the hole. Anything that you assume about the future of a company's earnings and revenue is just an assumption. He mentions in this book the importance of the fact that just because you have revenue growth year over year doubling every year for 4 or 5 years in a row, it will not continue that way forever. I mean, he doesn't say that, but I mean, it's impossible. You can't have a company double their revenue every year forever. Same with earnings. If earnings are, or if you're just not, ignore the revenue. I think he cares more about earnings than he does about revenue, by the way, from what I've gathered from this book so far in general. But if earnings are increasing every year, this could be a sign of simply undersupply, or this area is in a growth spurt right now, and growth spurts don't last forever. I think that's kind of the general idea of that. And so this is what we see for the valuation right now of Tesla, the valuation, and Nvidia. We've seen growth that's been crazy, going up at like an exponential rate of these companies, and the price of their common stock reflects that that's going to continue for many more years. And that's not necessarily the case. It's definitely not necessarily the case. And so, studying this book, understanding concepts of this book, help you understand the limitations of using earnings growth and revenue growth as a predictor of future growth. It's an error. It's an error to make. His way of doing it is, from what I gather from the book so far, ideally for him, for these guys, you look at the past 20 years of earnings, you take the average, and that's the number you should be dealing with. Not, well, they've doubled every year for the past 4 years, so they're going to double every year for the next 4 years. That's not a good way to analyze a security, and that's the way markets often do. That's why the markets are analyzing a lot of securities right now, actually. So don't fall for earning trends going up or going down. See, here's the other thing. If you have an industry like I mentioned, dry bulk shipping, one of Lynn Alden's areas she likes. If you have declining earnings or flat earnings or negative earnings for 10, 20 years, but it's still a service, it still has money coming in, no one's investing in ships. All of a sudden, this is one of those markets that's been unnoticed. It's like nobody cares about it. It's not hot. It's not popular. This is fertile ground. This is very fertile ground for explosive growth. And then, you can get into that overvalued phase eventually in that same area. So, and it's not to say that something like dry bulk shipping can't remain undervalued for forever. But as I've pointed out in my previous videos, if you had bought, I'll mention the Star Bulk dry shipping again. If you had bought it at its bottom in the past few years, it's like $8 a share, you would have gotten your full money back by now, and you'd still have the shares, which are now worth like $20. So you not only would have gotten all of your money back, you'd still have all of the shares that you bought at a higher price. And this was an industry that has been very low for a very long time. It's a perfect example of something like that from this book. So, all right. So yeah, using an average as a rough estimate of probable future earnings. So averages, not trend. Don't get too excited about trends, I think, is the main message here. So trends, again, they're numbers, but he says they are qualitative, not quantitative. I love that because, again, if you see earnings doubling every year for the past 4 years, if you interpret that as a qualitative mathematical figure, okay, now it's going to double next year, and then it's going to double the next year after that, and then it's going to double the next year after that. So let's price that into the price of the security now. Bad idea is what he's saying, because that is a qualitative aspect. You should not consider trends to be quantitative. You should consider them to be qualitative and treated as such. Often arbitrary, he even says, is trends are arbitrary. If you look at how a lot of securities have been trading over, since COVID, especially since securities have gotten more popular in general, people have not been treating them as arbitrary at all. And so I think this is a very rich point to get. And this is only chapter 2. And it's already full of just gold, absolute gold for understanding analysis. I still have 800 pages to go or so, and we're on page 45. All right, so very, very good book. Buy it, read it along with me. All right, guard against qualitative factors. Don't try to profit from qualitative factors, he says. They can't be ignored, but don't try to profit from them. So the last big point of this chapter is it's an area that I need to try to understand myself a little bit better, but it deals with industry expectations, which can affect the expectations of stability. So he compares a auto manufacturing company to a grocery store and shows how the earnings numbers of the grocery store have to be a lot higher to constitute the same price as an auto manufacturer having lower earnings. They're considered in the marketplace, and I think he agrees with this difference, is that some industries, because of higher volatility in food, grocery stores kind of need that extra buffer of higher earnings over a period of time. So compared to the auto industry, at least that's how I understand that part of the argument. Again, please comment below if you see this video. Let me know your thoughts. So the main point being, I believe what he's trying to say is that more stability doesn't matter across different industries. So you can't compare the numbers of a grocery store to a car making company. They have different ways of being more stable. Same with a bank versus a computer chip making company. You can't look at the PE ratio and say, oh well, this company has a PE ratio of 8 and this one has a PE ratio of 307. So the PE ratio of 8 is definitely worth buying because eventually they'll flip somehow, and this will they don't. Certain industries simply, I think he's stating, have certain expectations of certain quantitative aspects, and so you have to use that qualitative part of it to help interpret the quantitative aspects. That's why you have like Webull, that app. They always compare it to the supposed industry that the stock is supposedly part of, which is, if you look at what it's comparing to, most of the time you don't get a very good sense of valuation. You really have to think for yourself, like, what is this company doing? Where do they fit in the picture and everything? But okay. Yeah, so he discusses the preferred shares, how well the preferred share coupon or yield is covered, comparing a grocery store to auto parts. I think it's auto manufacturing. But yeah, so again, the title being the problem of analysis, quantitative versus qualitative factors. Know what the qualitative factors are, know what the quantitative factors are, and how they operate, how they work, how they can help you value a security. And you mostly want to use qualitative factors, but you need to not ignore the you need to use the quantitative factors, but you cannot ignore the qualitative factors. The qualitative factors do matter. Like, unfortunately, they matter. This would be a much easier game if only the quantitative measures mattered. So I think that sums up this chapter 2. I hope you enjoyed today's episode. Please like and comment and subscribe. And that's all for today. Thank you for listening in. Rob's Child.